Looking for safer investment options that still earn you money? Then you've probably heard of bonds. But what exactly are they, and why do smart investors rely on them? Let's break it down. In this video, I'll give a beginner-friendly guide as to what bonds are and why they are worth investing in. Hope you enjoy. So what exactly is a bond? A bond is basically a loan, whereas you are the lender. When you buy a bond, you're lending money to a government, corporation, or even a city. In return, they promise to pay you back with interest after a set period of time. So let's say you buy a $1,000 bond with a 5% interest rate in a 10-year term. That means you'll get $50 a year in interest, called a coupon, and then you'll get your full $1,000 back at the end of the 10 years with the interest included. This makes bonds a popular choice for people looking for a steady, predictable income, especially when compared to the ups and downs of the stock market. You can think of them as IOUs with a return. Instead of buying a piece of company like with stocks, you're getting steady income from lending your money out. When talking about bonds, we have to understand the several different types. First, we have government bonds, then municipal, and then lastly, corporate bonds. For the government bonds in the US, these are called treasuries, like treasury bills, notes, and bonds, and they all depend on how long they last. These are considered some of the safest investments because they are backed by the government. Next on the list, municipal, or munis for short. They're issued by cities or states to fund things like schools, roads, hospitals, general infrastructure. But the bonus to these is that interest earned on many municipal bonds is tax-free, especially at the federal level, and sometimes even at the state level if you live in said state. The corporate bonds, issued by companies to raise money, these usually have more interest than government bonds, but with a much higher risk. Why more risk? Because companies can go bankrupt. That's why corporate bonds are rated by agencies like Moody or the S&P from AAA, very safe, to junk status, high risk, high reward. And there's a grading system that goes on with that, as you can see on screen. And each type of these bonds has a purpose. So whether you're looking for safety, tax benefits, or higher returns, there's a bond type that fits your strategy. But just remember, higher yield usually means higher risk, and the key is matching the right bond to your goals and risk tolerance. So why do so many investors include bonds in their portfolios, even when stocks often seem more exciting? There are three main reasons: income, diversification, and risk reduction. For steady income from interest payments, to diversify their portfolio, and to reduce the overall risk, especially during volatile stock markets. The income side, most bonds pay what's called a coupon, a fixed interest payment you receive regularly, often every 6 months. That means a predictable cash flow that you can count on. This is very attractive for retirees or anyone who wants passive income without constantly watching the markets. For the diversification aspect, bonds tend to behave very differently from stocks, so when stock markets go down, bonds often hold their value or even go up. By holding both, you spread your risk across different asset classes, which helps smooth out returns over time. And finally, the risk reduction. Bonds, especially government ones, are generally less volatile than stocks. That makes them a great choice when markets are unpredictable or during economic slowdowns. Think of bonds as the seatbelt in your investing journey. They may not get you there faster, but they help keep you safe when the road gets bumpy. Now, before anybody goes all into bonds, it's important to understand the risks, because yes, even though they are generally safer, they are not risk-free. One of the many risks is the interest rate risk. When they go up, existing bonds lose value because the newer bonds are paying a higher interest, so your older, lower-paying bonds become less attractive and less volatile. If you plan to hold your bond until maturity, this isn't really a big issue, but if you needed to sell early, you could lose out on some money. The next big risk is going to be the credit risk. And that's a risk that the bond issuer may not pay you back. So this is more common with the corporate bonds or bonds from municipalities that aren't really in the best state. That's why credit ratings matter. Always check if the bond is rated investment grade, AAA, AA, A, and BBB. And then there's the inflation risk. So this one's a sneaky one. If inflation rises faster than your bond's interest payments, your real return, what your money actually buys, goes down. And I think the current interest rate right now is at 3.1%. So if you were to buy a bond with a 2.9% interest rate, you're still gaining money, but losing money to inflation. And finally, it's the liquidity risk. Not all bonds are easy to sell, especially with the lesser known or long-term bonds. You might struggle to find a buyer if you need cash fast. So while bonds are generally safer, they still come with trade-offs. The key is knowing your risk tolerance and choosing the right type of bond for your goals. So whether you're just starting out or looking to reduce risk, bonds are a powerful tool in any smart investor's toolkit. And if you found this video helpful, don't forget to like and subscribe, and thanks for watching.